This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
4 weeks of gains, and in that month, the Dow Industrial Average has popped almost 9%. So which sectors have bounced back the most? As stocks gain, oil slides, crude has fallen for 7 straight weeks, its longest such streak since 1986. Will lower prices force companies to merge? And 1 year later, healthcare enrollment under the Affordable Care Act begins tomorrow. And this time around, there are changes, challenges, and still some unanswered questions. All that and more tonight on Nightly Business Report for Friday, November 14th. Good evening, everyone, and welcome. I'm Tyler Matheson. Susie Garrett is off. Tonight, much of the country is seeing the first blast of winter. And today, stocks acted as if they were frozen in place. The Dow, NASDAQ, and the S&P 500 were little changed. But who's complaining? For stock investors, the past 4 weeks, all winners, felt like a month at the beach following a very chilly early autumn stretch. Here's how things look today at the closing bell. The Dow down a modest 18 points, but the NASDAQ was up by 8, and the S&P 500 ended a fraction of a point higher, but that was just enough to mark the index's 41st record close this year. For the week, the Dow rose a fraction, the NASDAQ was up more than 1%, the S&P 500 edged a little bit higher too, as you see there. Bob Pisani now with more on what's been driving the markets sharply higher since those lows back just a month ago.
It's been an up and down week for stocks with only fractional gains for the major indices, but the bottom line is we're essentially back to historic highs. Not surprisingly, the market has been led back by sectors that had the biggest declines earlier in October. Healthcare and tech stocks were having a great year going into October, but they got hit in the period between roughly October 8th and the bottom on the 15th. Now that makes sense. In a broad market decline, the leadership stocks are the ones that usually get hit the most. So Intel, for example, was up 34% going into October, but it dropped 7% in the first half of that month. But since then, both tech and healthcare have recovered all their losses and are essentially right back near historic highs. That period in early October also corresponded to a big drop in oil, which had been dropping for months, but fell an additional 10% in the first half of October. That put pressure on energy stocks, and here's where the story is different. Energy stocks have not recovered like the rest of the market has because oil took another leg down just as the rest of the market was bottoming in mid-October. That has limited the recovery in energy stocks. They're only up about 5% since the bottom on October 15th. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
A very important vote in Congress today, with the House overwhelmingly approving a bill that would resume construction of the long-delayed $8 billion Keystone XL oil pipeline. Supporters in the Senate say they have enough votes to pass their own version of the bill, okaying the pipeline next week, and that would set up a showdown with the president. He has stopped short of issuing a veto threat per se, but said today he opposed a bill that circumvents an executive branch approval process controlled, oddly enough, by the State Department. Now, the U.S. is producing more oil. At the same time, global demand for crude is weakening. That led the International Energy Agency to predict that oil prices, which tumbled 3% this week alone, will fall even further. Today, domestic oil did spike $1.61 a barrel, closing just below $76. Even so, this marks the 7th weekly loss in a row for West Texas crude. Well, despite today's gains, oil prices were down about 3% this week, with West Texas Intermediate even touching a 4-year low and trading under $75 a barrel for a time. Now, this steep price decline is spurring some interesting discussions within the industry. Jackie DeAngelis has more.
Oil prices in free fall, down 30% year to date. The main issue, a global supply glut. The U.S. is ramping production, trying to gain market share, and OPEC players are keeping production levels stable, not wanting to lose share. Some analysts and traders are predicting that prices could fall even further. Talk of $50 a barrel working its way through the pits.
Realistically, I see oil trading as low as maybe $65. And the reason why I say $65 is because at that point, banks will stop giving loans for new exploration, and many companies will find it hard to operate profitably with those low prices.
Crude price action has taken a toll on industry stocks. In fact, the S&P 500 energy sector, the worst performer over the last 3 months, with a drop of more than 10%. Amidst this backdrop, news that oilfield services companies Halliburton and Baker Hughes are in preliminary merger talks. The timing of the talks coinciding with crude price declines. Industry insiders speculating that cost cuts and synergies will be key for companies in this space if prices do go lower from here and stay there.
It's an interesting time to try to put two of these companies together. Oil prices have been on the decline. I would have to imagine that Halliburton is looking at this as an opportunity, potential consolidate at a time when oil field service stock prices have declined about 25 to 30%. So maybe they're thinking they can get a better valuation opportunity here.
I'm sure some companies are finding it difficult to operate profitably with these low energy prices, and I would expect more M&A activity in the sector if prices remain low.
One thing that could change the game, the OPEC meeting later this month. If the cartel makes a move to cut production to stem price declines, all bets could be off. For Nightly Business Report, I'm Jackie DeAngelis.
A double shot of strong economic data out today. The Commerce Department says retail sales rose more than expected in October as Americans bought more cars and shopped for more items online. And a new reading on consumer sentiment for November is at the highest level since 2007. Now, the news was a little bit less favorable across the pond. Gross domestic product in the 18-nation Eurozone bloc grew by just 0.2% in the third quarter. That's basically nothing. In a surprise turnaround, though, some of the countries that were hardest hit by the debt crisis are now seeing the fastest growth, including Greece and Spain. Well, Eurozone officials are joining President Obama in Australia tonight at the kickoff to a weekend G20 leaders summit. While organizers are preparing for world leaders, they're also bracing for protesters who were already out in force today. Oriel Morrison has more now from Brisbane.
What do you want? Justice! When do you want it? Now!
There are a number of key issues here at the G20 in Brisbane. Trade, economic growth, jobs. One of the main issues, surprisingly enough, is security. That's after those reports that there are Russian troops moving into Ukraine. UK Prime Minister David Cameron talked about this in a press briefing earlier on Friday, essentially saying that sanctions are on the table if Russia refuses to cooperate. Now, aside from security, tax evasion is also key, very high up on the agenda, but the elephant in the room is certainly climate change. Tony Abbott has made it clear he doesn't want that on the table. He said it will clutter the agenda, but there are others here that say that economic growth and climate change essentially go hand in hand. So Tony Abbott has conceded to have one paragraph on climate change in the final communique. $100 million is being spent on security for this particular event, which involves 5,000 police and 1,000 Australian Defence personnel. Back to you.
And that was Oriel Morrison reporting from Brisbane. Well, back here in the United States, it is that time of year again. Starting tomorrow, enrollment opens on the Affordable Care Act's newly revamped healthcare.gov website. So what's in store for 2015? Bertha Coombs has more.
Healthcare.gov's start page has a new face, and President Obama's new HHS Secretary, Sylvia Burwell, says the online marketplace is ready for a fresh start.
We have done the testing. We have put in place all of the contingency plans. We have tested everything from loads to end-to-end.
It's going to take time. It's just life.
Despite the disastrous launch of open enrollment a year ago,
clearly the end-to-end testing was not sufficient.
8 million Americans enrolled in Affordable Care Act plans for 2014 after a massive fix of healthcare.gov. This year, the online application is shorter, there's more information up front, the small business shopping portal will launch after a one-year delay, and more insurers are offering plans. United Healthcare is selling plans in 23 states this year, up from 5 a year ago.
Certainly from everything we've heard from HHS, their expectation is that this will be a much simpler experience for consumers. The window shopping functionality seems to have worked well this week.
For investors, there's more confidence the insurance industry can make money on the exchanges, even with older enrollees who tend to use more services.
We've gotten to the point where companies like WellPoint, HealthNet, and even Aetna are signaling that this could be and is a profitable business.
But new headwinds loom for ACA. The Supreme Court is going to hear King versus Burwell, a case challenging the legality of plan subsidies in the 36 states on healthcare.gov, arguing ACA only allows them for state-run exchanges. And the new Republican majority in Congress is not likely to legislate a fix.
I think both the things coming together makes it particularly challenging.
But near term, analyst Anna Gupta says the focus will be on enrollment numbers. Already, the Obama administration has tempered growth expectations.
Even if the exchanges work properly, the administration and insurers still face a challenge of getting people to sign up during open enrollment, which this year will be shorter, running 4 months instead of 6. And awareness remains just as low. According to a Kaiser Family Foundation poll, 90% of young people surveyed were not aware that open enrollment was beginning. Bertha Coombs, Nightly Business Report, New York.
Cece Connolly joins us now to talk more about what we've learned over this past year about the Affordable Care Act and what you may need to know for this open enrollment period. She's managing director with PwC Health Research Institute. Cece, good to have you here with us. Is it going to work this time?
It's going to be better.
Better.
Yes.
Won't work necessarily for everybody, but basically the shutdown of the system that occurred last year won't recur.
We feel much more confident, the government feels much more confident that this time around they've built in capacity, they're a little more ready for the crush this time.
What's new or different this year? What should people expect when they log on?
Well, the best news for consumers this time around, Tyler, is that you're going to be able to window shop. They can log on to that healthcare.gov and they can start doing the comparison shopping without putting in all of their information and starting to enroll. That was a big problem last year where people didn't really get to shop before they got locked into a choice.
That's right. I remember trying to log on, and you had to log in and get all set up, and some of that process was buggy, to put it mildly, before you could start to really go and look at different plans to see which one would work. What do we know, if anything, about pricing this year versus last year?
Our Health Research Institute has tracked all 50 states and the District of Columbia. The average premium increase across the nation for individual plans is 5.6%, but there's wide variation. You can actually get cheaper plans and you could see big increases. So people really need to shop around, and that's most important, Tyler, for the people that signed up last year, because we are noticing a trend where folks that bought the lower priced plans last year are seeing the biggest increase.
The so-called silver plans, or those
plans.
And it was, what was it, gold, silver, bronze, or what was it?
It's like the Olympics: bronze, silver, gold, and platinum.
And platinum being the highest price one. Let's talk about the success or failure of the program so far. Are more people now covered by insurance than were a year ago? And who are they? Are they the young people that I know the insurers wanted to make sure were there to help them with their risk pool?
We have about 10 million people who have health insurance today who did not have it a year ago. Big jump. We also had a few million more that had even gotten in prior to that if they were under 26 and they signed up on their parents' plans. So a significant increase in terms of newly insured in this country. Young people, they did okay, not fabulously, but they did okay, and that's a pretty encouraging sign. The other big gap right now are Hispanics. Disappointing.
Who have not signed up in the numbers that were expected. Let's go back to the question of pricing and the point that was raised in Bertha's piece over the subsidies. How big a threat, really an existential threat, to this entire Affordable Health Care Act is that Supreme Court case? If the subsidies are ruled unconstitutional, is the whole system going to collapse?
Well, the fight in the Supreme Court is over just the federal exchange. So you're looking at about half of them in the country. But I think existential threat is absolutely correct, Tyler. If you wipe these away, we had 85% of the people who enrolled a year ago qualified for subsidies. In most instances, the people that got a subsidy paid 24% of the published premium price. So their monthly premium.
So they were paying $80 a month as opposed to $400 a month.
Exactly.
Or thereabouts.
Very, very significant for the consumer and the insurer.
Cece, thank you for coming out.
My pleasure.
We'll be back. We'll check in with you as the system goes along, the year goes along. Cece Connolly with PwC Health Research Institute. Great to have you with us. Still ahead, looking for stocks that could see double-digit gains over the next year, even if interest rates rise. Our Market Monitor has some recommendations. Virgin America has really lifted off as a publicly traded company with shares soaring more than 30% in today's trading debut. The IPO marks the latest move by an airline to cash in on the sector's surging popularity with investors. But is Virgin America likely to fly high like other airline stocks have this year? Phil LeBeau has our report.
A soaring debut for Virgin America. A rousing opening passengers on Virgin America flights toasted with champagne as they watched the IPO live on TV.
We will come out of this with a very strong balance sheet, a good liquidity position, and a good debt coverage position. So it's an extremely important day for our company.
Over the last 8 years, Virgin America has gone from losing money to turning a profit in 2013. Along the way, the airline based in San Francisco has primarily focused on cross-country flights that emphasize passenger service. One example, on Virgin America, you order food and drinks from your seat instead of waiting for the drink cart to amble down the aisle.
There's a niche for a carrier like Virgin because, frankly, there are people out there that really aren't brand loyal to American or United or even JetBlue, and you can get those people.
But Virgin America faces stiff competition from established airlines. Delta, American, United, even JetBlue are all pushing lie-flat seats on transcontinental flights as they try to win over the most lucrative customer, business travelers who frequently fly from coast to coast. Business flyers generate 40% of Virgin America's revenue, and the CEO believes he can keep those customers.
If you look at our first class, for example, we have 8 seats up there. It's a small cabin, it's an intimate cabin, and it's a controlled cabin. So it's more like a private flying experience. So it's a very different experience than you get with, having 30 or 40 lie-flat seats on a United and American.
Airlines are enjoying one of their most profitable years ever, with some stocks, like Southwest, more than doubling over the last 12 months. Will Virgin America shares climb even higher thanks to renewed interest in airline stocks? That depends on whether bookings remain solid while jet fuel stays in check. But for now, Virgin America and its investors are toasting a big day for the little airline. Phil LeBeau, Nightly Business Report, Chicago.
An activist hedge fund takes a stake in McDonald's, sending shares higher. And that is where we begin tonight's market focus. According to a filing out today, Jana Partners now holds a position in the burger chain that's worth more than $81 million. This comes as the fast food giant has seen weak sales across all of its units so far this year. Shares almost 1% higher, though, today at $96.21. The accounting issues at Hertz are worse than originally thought. The car rental giant says it will restate its 2012 and 2013 earnings. This is in addition to restating its 2011 results, which we already knew about. Shares tumbled 4.5% to $21.69. Shares of Graham Holdings climbed higher after it announced plans to spin off its Cable One cable division into a separate publicly traded company. Investors cheered the breakup of that company. It has, of course, sold its Washington Post newspaper unit last year to Amazon's CEO, Jeff Bezos. Graham's holdings today up more than at $85 higher at $878.87. And Pandora surged after a filing revealed that its chairman and CEO purchased 25,000 shares of the stock. This marks the first purchase by any Pandora insider since its IPO more than 3 years ago. The stock was up 16.5%. It closed at $21.51. Our Market Monitor tonight says it's never too early to be thinking about stocks that will do well in a rising interest rate environment. He's Derek Bruton, CEO with Lucia Capital. Derek, welcome. Good to have you with us. Do you really think interest rates are going to go up anytime soon? And if so, by how much?
You know, I don't think so, Tyler. I think we're really looking at mid to late 2015. Every time I think there might be a hike here, we may see the Fed move off their dovish stance. What we tend to see is more weakness, more spottiness, a little more unevenness in the GDP, whether it be labor, whether it be housing. And so I still think we're not going to really see any moves till late 2015 or so.
But these stocks that you're going to mention to us, beginning with NXP Semiconductors, you think would be good for the current environment and I guess could benefit or withstand rising rates. Tell me about NXP.
You know, NXP is really about Apple Pay. And I can't say enough about Apple Pay. All the excitement about the iPhone 6. But I really think Apple Pay is really going to transform the world much the same way iTunes did the music world. What we're seeing right now is NXP, is the semiconductor, provides the chip for the phones that communicate with the retailers. Should Alibaba or anybody do anything with Apple Pay, I think this is really going to take off. They're also involved in autos, in security for credit cards. I think they're well positioned and they've got a lot of room to run here.
Let's move on to another one that has been a hot company, Gilead Sciences. You've got a price target of 135 to 140 over the next 12 months. Why do you love it?
Well, I love it because of just the massive pipeline of drugs they have coming out under review right now, both HIV drugs, cardiovascular. They've getting a lot of talk right now about their hepatitis C drugs. They're leaders in the industry, first to market. There's over 100 million treatable patients out there with hepatitis C. I see this stock really being able to take off and taking advantage of its dominance in the market.
Let's move on to number 3, and that would be Dow Chemical.
Dow is just more so than any of its competitors right now leveraging natural gas and shale oil production. It's a cash-rich company. You probably saw they increased their dividend by 14%. They announced a massive buyback of shares. And they're also doing well to respond to criticism out there about being in unprofitable business lines. They're divesting those business lines, focusing on really strong, high-value chemical and service sales.
Overall, Derek, do you like the market where it is today and think it can churn higher?
I absolutely do, Tyler. I think, you know, we see the spottiness in the market, like in GDP, as I talked about. But I think these are just opportunities to get the dollar cost average back into the market. We did so in October with nearly a 10% drop. I think we're on the road with some bumpiness, 3 to 5% corrections, depending on what happens overseas, what happens in some of the earnings reports.
Right.
But this Santa Claus rally, I think, will take us right into a strong first half of 2015. And then we'll finish off in hopefully high single-digit percentage growth in 2015.
Well, ho, 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 Derek. Thanks very much. Santa Claus Rally. Derek Bruton with Lucia Capital. Coming up, how the freelance economy is changing the way companies hire and Americans work. And finally tonight, have you ever thought about becoming your own boss, working for yourself, maybe even as a freelancer? Millions of Americans do it, with the so-called freelance economy growing every year and changing the way America works. Sharon Epperson has more.
Kyle Davidson has been on many adventures, but one that's been most meaningful came after he left Living Social, an online marketplace that features local deals for its subscribers.
Living Social decided to sort of refocus the core business, refocus sort of their strategy a little bit, and decided as a result to shut down the Adventures division nationwide.
Davidson had worked on that team, crafting deals on snowboarding, skiing, rafting, wine tours, and other trips. When his job came to an end, he embarked on a new adventure, launching his own business, creating an online marketplace that's designed specifically for consumers seeking active excursions. And he hired a bunch of freelancers to work with him, mostly members of his old team.
So rehired a lot of my part-time staff, from Living Social, we employ 23 freelancers, and we call them group leaders. They're our guides on our trips, and yeah, every single one is a freelancer.
There's been a dramatic increase in the number of people working for themselves over the past decade. About 53 million Americans are doing freelance work today. That's about 1/3 of the entire U.S. workforce, according to a recent study commissioned by the Freelancers Union.
The whole landscape is changing. I think the digital age has played a huge role in that. The market right now, I can get great freelancers. So if I can have access to that from anywhere, why wouldn't I work with freelancers? It only makes sense for a CEO or anybody running a company to do that.
For Davidson, having a freelance staff is essential for his business.
It's much easier to have a larger staff because you have sort of more flexibility in terms of scheduling. The more people we have, the more options there are for who can work.
Hiring freelancers provides more options for businesses, large and small.
It's going to change the way that corporate America works, that the small business landscape operates, because you have access to different kinds of people on shorter term assignments. The work environment is changing from thinking about long-term careers, which is what sort of we used to do in the past, to thinking about work on a project basis.
The freelance economy changing the way Americans work and the way companies hire. For Nightly Business Report, I'm Sharon Epperson.
And that is Nightly Business Report for tonight. Thanks for watching. I'm Tyler Matheson. Have a great weekend, everybody. We'll see you back here on Monday.
Nightly Business Report has been brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
I'm Tyler Matheson with a Nightly Business Report news brief. Stocks end this Friday mixed and little changed, but wrap up the fourth straight week of gains in the major averages. Today, the Dow did fall 18 points, but the Nasdaq was up 8 and the S&P ended a fraction higher, just enough for its 41st record close this year. Shares of the airline Virgin America soared 30% in their first day of trading. Retail sales rose more than expected in October, with Americans buying more cars, doing more online shopping. A new reading on consumer sentiment for November is at the highest level since 2007. And PIMCO has reportedly awarded former bond fund manager Bill Gross, who unexpectedly quit the firm he founded in September, a $290 million bonus for the year 2013. And tune in to Nightly Business Report here on your public television station.